Hello, YouTube. Today we're going to be talking about whether or not the stock market bull party has legs for it to continue to go higher. And the reason why is because we want to know whether or not we actually just got a Fed put. Did the Fed just blink? The reason why I'm mentioning this is because we're right around the 200 weekly moving average, but did not quite hit it. We're about 10 points higher. But if we look back to what we reviewed last weekend, again, this is from Bloomberg. It's talking about how there is a big test here. SP 500 is approaching a crucial 200-week moving average and a Fed put. So if we are going to avoid 2000 and 2008 and potentially get a 2011, 2016, or 2018 bounce off of a Fed put, this is the most important thing for us to be paying attention to because the saying, don't fight the Fed, is very, very, very important. And if we're going to be getting a Fed put or a Fed pivot, meaning they're now going to maybe shift gears, that's what we have to pay attention to with Jerome Powell speaking this week and with a lot of economic data coming out. And again, I'm trying a new format for the video. Drop me a comment and let me know what you think. Do you like it? Do you enjoy it? And let me know if you like the evolution of the channel. If you're new here, we talk about stocks, commodities, crypto, individual stocks, indices, everything, every day except for Sundays. If you enjoy that, please subscribe to the channel and smash a thumbs up. I would really appreciate it. So economic data we have for this week is going to include consumer confidence on Monday, a potential a GDP revision for better or for worse, Powell speaking at an ECB event, the end of the quarter, a bonus OPEX day on Thursday, and then we got European CPI and ISM manufacturing coming out on Friday. So in terms of whether or not we're actually going to be getting, one more thing here, because we have to ask ourselves, again, if this bull party is going to have legs, does it actually have juice for a few days, for a few weeks, or potentially for a new bull market? So looking forward to July, we're going to have payroll Friday on the 8th, US CPI on the 13th. We're going to have earnings season kicking off around the 14th with banks. And then we're going to have the FOMC meeting on the 27th as to whether or not they're going to go by 75, 50, or maybe even a full percentage point. All right, so now that we understand that, now let's have a look at some charts. And I'm going to go through some articles. As you can see here, there's some tabs open. But I'm trying to think about how can I provide the most value in the least amount of time? So I'm actually re-recording the video because as I started recording, I realized that there actually is a much bigger story I can tell here because this is very simple, and I think simple is best. So instead of trying to get too complicated right out of the gates, we understand that there's really important data coming out not only for June but also for July, and Jerome Powell is going to speak again, end of the quarter and rebalancing. And then going literally into some huge data. So as we're looking at the chart, what we have to ask ourselves is, are we building up enough pressure to actually have the net effect from these big catalysts be bullish into the end of July, which is roughly a month from today? Or is this kind of a trap, meaning another trap? All right, now let's look at the chart. So first thing we're going to look at is going to be 2000 and 2008, which was roughly a 3-year and 2-year contraction. So how do we know if we're actually repeating 2000 and 2008? Well, according to this right here, it's actually really simple. So now we're going to go back in time and we're going to adjust this to auto. We're going to have a look here at a couple of indicators. So what I want you to be aware of is going to be the blue line and then also the black line. So as we look back in time, the black line is going to correspond with a black number, the gray number. The blue number, again, you guessed it, is going to correspond. The blue line is going to correspond with the blue number. So as we look back in time, what's going to be really important is the relationship that the stock price or the candlesticks have relative to the blue line and the black line. So just note what's happening here. We went below the blue line, dead cat bounced back above, and now we are below, and we are around the 200, but did not actually test it. So now let's look back in time and see what happened in 2000 and 2008 to see whether or not we're actually going into a deeper bear market. So let's zoom back in time here. Here we got 2000, here we got 2008, and what happened? Well, this was a decline of 50%, roughly 150 down to roughly 80 twice, right? Roughly, not exactly. However, what do we have relative to today? Well, here, again, we lose the 50 and we're around the 200. So right now, I would say our current correction is right here. If it's 2000 and looking over to 2008, what do we have? Okay, so we lose it, we reclaim it, we get back below, and then we are right around that 200. This is right where we are as well. So here's the important distinction is that if we're going to be repeating 2000 and 2008, where we are right now leads to what? Well, it leads to an actual test of the black line. So if we're actually going to be repeating 2000 or 2008, well, if we're going to go to negative 40, negative 50, first of all, we have to go down by negative 25 and negative 30, which means that we have to physically touch this black line, and then we have to lose it. So we have to lose the 200 MA. That's what happened in 2000. Now let's look over here to 2008. Same thing. So we got really close, and then we actually test it. And then the next stage here is going to be where we actually fail. So the fail actually comes in when we what? Here's the important part. And again, I'm re-recording the video because I recognized this as I was recording it the first time. So lose the 50, lose the 200, reclaim the 200, but fail to get back above the 50. That is our kiss. That's our kiss of death. All right, in 2000, that's what led to, again, from the peak or the all-time high down to from here. That was about right. We did about half the move, about negative 30. We recouped to only being down by about negative 15, and then from here, that's where we start to precipitously drop. That's where our negative 50 actually starts to get confirmed. Never reclaimed the 50 either. Now looking back to 2008, what do we have here? All right, so lose the 50, lose the 200. Reclaim the 200 and what? Fail to reclaim the 50 MA. And again, same rough pattern here. From peak to trough, we declined by roughly 20%. Not all that bad. Now we recover by what? Sorry, we recover to be only down by about negative 10. We recoup 50%, or we retrace by half. And then from here, from negative 10 down to what? Oh my goodness, negative 58. Yep, that's where the nasty drop was pretty much confirmed, where we're going into a secular bear market. And that's really, really, really important for us to understand here. So the relationship between the 50 and 200 MA, for me, is going to be probably acting as my North Star for the next little bit. So now let's look at what happened in 2011, 2016, and 2018. So now we kind of know what we need to see to avoid 2000 and 2008. Now let's look and see whether or not we are repeating 2011, 2016, or 2018. Why? Because if we want to be rule-based technical analysts, we want to know whether or not we are actually going into a secular bear market or if we're not. All right, so now zooming out here to 2011 and 2016, those will be these periods right here. Again, 2011, and then we got 2016, we got the drop right here. All right, let's look. So what happens? All right. So 2011, what do? We lose the 50, lose the 200, and then reclaim the 50. That leads to a huge expansion, right? From roughly 150 uninterrupted to about 200. That's almost a doubling. All right, cool. So what's our confirmation? Reclaiming the 50 MA, that 50 moving average. That is the bullseye right here, the blue line. Once we get back above the blue line and actually lose the black one here, that leads to the new expansion or a new bull market, the birth of a new bull market. In 2016, now we look at the same relationship here where we lose the 50, get close to the 200, don't actually lose it. The confirmation comes where? By getting back above the blue line or back above the 50 MA. And from going here to from roughly 200 to about 300 uninterrupted, that's roughly a 50% expansion. All right. Now let's look at 2018. Oh, it looks like there is a pattern here, Justin. It's a lot easier to understand than it was even before. This is very simple, isn't it? I think it is. Lose the 50, touch the 200, reclaim the 50. There's our bullseye right here where we get back above that 50 MA. That is our North Star. That is our confirmation. And then what? We go from roughly 235 up to roughly 350. Gain another 100 points or what? A 30% expansion. So sorry, roughly 40. So each expansion gets a little bit less acute, which means it goes up by less percentage, but it's uninterrupted for a period when it gets back above the 50. And again, does not close below for more than 2 candles or 2 weeks. And then what happens here? Now we got 2020. It recovered pretty fast. Where was the big drop? Well, again, we get multiple candle closes below the 200. We reclaim the 50, and then we have an uninterrupted expansion for what? Pretty high here, right? We go up by roughly 60% again. Okay, so isn't that simple? Isn't that very easy for us to understand? All right, so now let's keep that in mind. So Every previous time that we've actually started a fresh expansion, again, in 2011, 2016, 2018, we got pretty close to the 200. I'm talking within like 1 or 2%. Are we close enough to that here? Technically, we're about 3-4% off. I would say maybe it's close enough, but because of the fundamentals, I would say actually no. So now what we want to ask ourselves is there more to the story than just what we see in terms of the relationship between the 50 and the 200? And again, if you're enjoying the video, I would really, really appreciate a thumbs up and drop me a comment. So again, trying to tell the story back here, and again, I'm repeating myself on purpose here. We're gonna have a few things that are going to come out this week. So if now we're going to be looking for a bull expansion, we have to be looking at what's going to be coming in the early part of the week, the mid part of the week, and the later part of the week. The data that is bolded and underlined is the most important. Powell speaks on Wednesday. He's going to be speaking at a symposium at an ECB conference. So first thing I want to point out here is just that Jerome's going to be discussing an economic policy panel at the ECB, and this is going to include Governor Bailey from the UK. It's going to include Christine Lagarde from the ECB, and it's also going to include Jerome Powell from the Fed. This is important because right now the ECB planned steps at an emergency meeting to address market crisis. So what did we just talk about? A Fed put. What is this literally telling you? The ECB had an emergency meeting regarding the ECB put. That's the way I'm reading this. And with that data coming out, that's a conversation happening on Wednesday, the 29th, I'll be paying very close attention to it. So again, that's just a quick little preview for what I think is going to be the most important data point. Then we have the end of the quarter, which is going to be a rebalancing, and we're also going to have a bonus OPEX. That's right. We're going to have 4 out of 5 days having options expiry this week. Last week we had 3 out of 4. This week we got 4 out of 5. And then we also have European CPI, which I think is important, but not as important as American CPI. We got manufacturing, and then next week, again, in roughly the next 4 weeks or the next 4 candlesticks, we want to ask ourselves, if the bulls are going to continue to go, are we expecting positive numbers from these reports? And if we don't, how can we know that the pattern's starting to get invalidated? All right, so with all that in mind, what I want to do next now is actually jump forward to a section that's going to be new to these videos because I want to try to do something different. So now we talked about that relationship with the 200 weekly moving average. One last thing I'll point out here just regarding the 200 weekly is that SPY is our North Star, or what we pay close attention to. But there's one other asset class that I think is pretty important to talk about right now, and that is Bitcoin. And the reason why is because, as we note here and we delete all the lines, again, where are we? We're below that 200 weekly. So this is really important. It's a nice big round number 22,500. It would reclaim the 200 weekly moving average. And this is one of the only asset classes that is currently below it. Ethereum, which has actually been larger percent declines, is actually battling for that area right now at about 1,200. So I would really want to see BTC back above that 200 weekly moving average for me to have confidence in all risk assets this week, because we also note that ARK is way off. So with the death cross starting to form here, ARK has to rip an additional 65% to reclaim that 200 weekly. So with ARK and Bitcoin both below, but with nice weeks, right? ARK is up 18%. That's incredible. I want to see more. I don't want to see us just base here at about $46 or that key relative low. We have to advance. We have to advance. We have to advance. So we'll talk about this a little bit later, but at a high level, that relationship with the 200 weekly is really important. In a moment, we're going to talk about how high the market can actually go. And that'll be important for us because, again, I just laid out the case that if we're actually going into an expansion, should we believe it? Well, I don't know. New section to these videos coming in at the beginning of the video as well, trying to front load the value. Here we're going to be talking about how we have the support and resistance levels for the week. So with the relationship that I just told you regarding where the market could go if we're repeating 2000 or 2008 or 2011, 16, and 18, now we're going to be keeping in mind these numbers for support and for resistance as we now start flipping over to what the market could do if we go up, down, or flat. This is the new section here. So I'm actually going to provide an overview on the chart in terms of what I would be looking for an up week, for a down week, and for a flat week. So again, looking at these numbers here, we understand that we're mostly looking for gaps on the upside all the way up to our 50 DMA. On the downside, we're looking for potentially going all the way back to our 2020 highs. We're mostly going to be looking at weekly lows, and we got our monthly higher low. So there we go. That's what we're going to be looking for. That number there should actually say, right, that's our daily gap. So that's a typo. I'll fix it after. 380.54, which is our key relative low. So now, again, if we're going to be getting an up week, what I would be looking for would be immediate continuation. And the reason for that is because we're closing at the high of the week. So we're closing at the high of the week. We're up by 6.62%. And anytime we close at the high of the week, it means pressure is building up. The high of the week is 390.09. The closing price on Friday, 390.08, which means we close at the high of the week within 1 cent. A single cent. That is correct. So what should happen is that we get immediate follow through. That's what normally happens. But this bear market is anything but normal. So if you look back at previous periods where we had fat green candles, here we note that that actually led to a gap down. Okay. So if we get a gap down next week, maybe we have to be a little bit more mindful because that led to a big old nasty drop. Over here, the last time we had a big green candle, we had a flat open, we formed a tail, and then by the beginning part of the week, we were up. Okay, cool. That's pretty interesting. That's what we have to pay attention to. Same thing here, right? We open up roughly flat, form a tiny tail, and then push up. So that's what I would expect for an up week this week. In terms of where we could find resistance, I'd be looking for 395 to 396, 400 to 402, and then ultimately 405. The way we could get there is by simply looking here at our daily chart that we've been looking at on previous videos. And again, understanding that what percent have we actually put in off the low? So this period right here, what percent advance did the S&P go higher? From peak to trough, from trough to peak or from low to high, roughly 7%. And you're going to note that I have this period over here highlighted. And the reason why it's highlighted is because we went higher by about 7% in 2 days. This time it took us 5 days, from last Friday to this Friday with one holiday day on Monday. We put in about the same percentage off this low down here. What's missing? Volume. So this came in a single day. This got spread out over 5 days. So if we're going to be going higher, again, I'd be looking for a continuation, but ultimately we need to stage a higher low. And we retraced a large part of this move before ultimately going higher and then failing after. So what I want to look for is not just where we stage our high, but where we stage our lows, because we formed an uptrend. And right now, this uptrend is very acute or sharp, which means that we pretty much have to keep our current rate of advancing for us to maintain this uptrend. That's going to be hard. And as this 50 MA starts curling down, we're going to form some natural resistance in here or a big old test. So that is where we get our 405 is our resistance 3, or where the bulls score a touchdown. If they can get us to the 50 DMA, the bulls win again this week. There's going to be that natural resistance at 395 and 396, and then 400 to 402. And that is just going to be from the beginning of the gap for the next one up to the current, from the start of the gap to filling the gap. Kind of what we did here, where again, we enter the gap zone. So let's zoom in here to the current period. So we zoom in here to the current period, and then we look and see, once we actually entered the gap zone, we advanced to where? Fill the gap. And I remember saying, I think it was last week, if not this week too, that I think that if we start filling the upside gaps, we're going to fill both of them. And with the pressure building up, there's no reason why we can't just shoot higher and fill these gaps. And then what? Had the 50 MA curl down, we get a big old test and see if we actually have more juice at this tank. Why? Again, let's look back to our dates. So now we understand that if we're going to keep going higher, we have to get through all of these big dates. So we have to get through all of this as being bullish, and then we also have to have bullish continuation all the way through to July. All right, so that is how we have a bull scenario. In terms of a bear scenario, or how do we get down into these support pockets? All right, let's have a look and see what would happen. Again, my base case is actually that we're going to be going up as well, just to make that clear. So if now we're going to be getting a down week, what would that look like? A down week means that we're going to be going into support. And the support here is found on weekly lows. And again, that's the gap fill at 380.54. We got 379 as our 2020 high as well. So now if we look at what would it take for us to, again, if we look at the weekly chart just to understand what we're starting from, the weekly chart tells us that, okay, if we were going to get a back test, 380.54, where does the number come from? Well, that's going to be almost our lower level of support. You'll also note that I did put in support 4, and that is intentional. And that's because there's a daily gap on the chart. So, sorry, there's a typo here. It should say 1, 2, 3, 4. Yep, I make typos. I'm sorry. Should have probably checked that before I hit record. So support 1 is going to be 387. Support 2 is 385, or our weekly lows. Support 4 is going to be 381. And then support 4 is going to, support 4 is going to be 379. So now if we have a look here, what I'm basically saying is that if we lose this green line, we are going to be losing our relative low. And that means that this is just a dead cat bounce before another nasty cut. And this is so important because we're currently forming a falling wedge. And if we invalidate this pattern by continuing to go lower, what it tells me is that this inverse head and shoulders, which should form, is invalid, right? This pattern is not going to complete. And this pattern right here is voided, which is going to be our pink descending triangle. So it's drawn blue on the chart, but that's what we're looking for. So if we're going to backtest the breakout but fail to advance, this pattern is invalidated. It's a falling wedge breakdown. So that's really important for us to keep in mind. So now as we keep that in mind, as we look forward here to the video, looking here, we did get a false breakout once, and we came all the way back down to the bottom. If we get a false breakout again and we lose the green line, it means that we are not actually completing a falling wedge breakout. We cannot go below here. Why? Because we're going to be losing the back test of our key downtrend. So if we lose that 380.54 and close below 380 this week, it's kind of lights out for the bulls. It's another dead cat bounce and another fail. Cool, right? Yeah. So our support starts at those weekly lows at 387 and 354. And that's going to be this low right here and this low right here. So before we have to deal with the last low at 380.54, we have the 385 and the 387 areas. That's where they come from. And then additionally, again, it's not really a support or resistance. It's kind of center field, but we have that 390 area right here, 38975. So there is quite a bit of support. We got 4 weekly lows we would have to lose again in order to actually break down. There we go. There's the new section. So keeping all this in mind, again, my base case is that the technical pattern says we should be getting a breakout. There's some stuff happening over the weekend, including protests that, again, might have potential, but it's not really what my base assumption here. We're going to look at, we're going to look at one more thing, and that is now going to be the psychology chart updated. So the reason why this is important is because if we're truly going into a bounce, meaning we're going to get a bear market, big old bounce to where maybe back up to 450s, which is what I was calling before. We have to check in on our chart to see what it looks like. So now let's flip over here to our monthly chart. And again, we're trying to zoom out a little bit because what? Well, again, on Thursday, we're closing out the month. We're closing out the quarter. So this candle is now going to be closed out, and where we are is going to be really important. Notably, we have the key low here at 380.54. And closing below the previous monthly low, it's hard to say that's bullish. Last thing is that we also have our pink line right here, which is resting at about 403 to 405. Call it roughly 405. So 405, was that number already important? Yeah, it was. And if we can close the month above the pink line, what does it tell us? Well, it tells us that, hey, we probably had another breakdown, and now we're going to be going back up, potentially as high as the red line, or retesting our neckline. Where is that? That's all the way up here at about 450. Yes, it is. So the only way that I can see us getting to 450 is if we at least get back above 405. And if we look at the daily chart one more time to try to understand why that's important, it's important because our 50 MA is crashing down, and 405 is likely where it's going to be as the monthly candle closes out. So if we are able to get to the 50 and close above it and then continue, it means that we're actually starting to complete the psychology chart where everyone's thinking, we just have to cool off before the next big rally. And that's what everyone's kind of thinking right now. It's a bear market bounce to start, or meaning a dead cat bounce. It could easily lead into a reversal. And that is pretty much the potential if the bulls have legs here. So if the bull party is going to continue, we could actually go quite a bit higher. From where we are today to where we could go, that would lead to roughly... right here we have a look and we see that, okay, from where we are today to roughly 450s, again, that is about 16% more. So that would be a repeat of this week, roughly 2.5 times more. What's also super important here is the relationship between the 50 MA and our ultimate target. So again, we are looking for up to the red line. Does not mean we're going to hit it. That's where we could get up to. But is there resistance before then? Absolutely. Where? At the blue line, which is what? 439.42. And again, that is the relationship that we just looked at in terms of the Fed put. So when we think about the Fed put and the relationship between the 200 and the 50, how are we going to get to 454 if we can't get through that 50 weekly? And what I'm pretty much telling you is that if we get to 454 and we can actually claim it, what that might mean is that we're actually going into a new secular bull market. Why? Again, let's look back in time at 2011, 2016, 2018. What happened? When we get back above the blue line, what do? We go up a lot. So here we go, what? Up a lot, right? It goes up big time. We look back at 2018, gets back above the 50, booms, right? It goes higher. All right, cool. Now let's look back at 2011. Oh man, this is like the most violent one. Yes, sir. It definitely came from a violent crash, right? So don't get it twisted. But once it reclaimed the 50, it bounced once, bounced twice, and then went up massively. So that is your bull scenario. Technically speaking, that is what we need to see on the chart. And you'll note so far that we've not looked at anything else, including QQQ or XLF or anything. Why? The market is SPY. That's what I personally care the most about. All right, so now that we understand all this, we also understand that we have the paralysis rather than panic best describes investor positioning. And I have a few more things for supporting evidence this week to try to tie it all together. But we want to understand that there's only been about 3% of redemptions, or $3 out of 100. And that's on $1.1 trillion of inflows at 42.74. So what that tells me is that as we look forward to here, and we add back in our volume profile, what it tells me is, again, the median price paid so far this year, since about 2020, is 437. Okay, cool. So that's roughly our 50 weekly moving average. Yeah, it is. So again, let's hide all the trend lines. That's the median price. And how are we going to get to the 50 weekly moving average if these guys just want their money back, right? They get a chance to get their money back and take it. We're probably not going to go higher. That's what we have to keep in mind here. All right, so now let's just go back and put our lines back in. Let's put our lines back in. There we go. Now we're going to go back to here, and we're going to continue the story. So I think, again, if we keep this in mind, that $1.1 trillion, we went down to roughly 360, and they're starting from about 427. Yeah, they lost about 15%, right? These guys lost about 15%, 15.5 on average. Some lost more, some lost less. But at those lows, they were down by 15%. That's a pretty big loss. So what did they do instead? They shorted the shit out of the market. Selling was never more furious than the last 2 days. Why? They're trying to fix their shitty trades. Oh, we bought the dip and we got burnt. So again, this is from June 14th. We also look here too. Goldman buyback desk was flooded with orders from the stock route. So the reason why I'm pointing to this is because we have a key date here, June 14th. And we're also told that, again, people were furiously shorting the market at a low. Why? Probably because they got their butts handed to them because they've lost a whole bunch of money. So 0.15% on 1.1 trillion means that collectively, 0.115. So people lost about $160 billion just on that 1.1 trillion of inflows, not including old money. So now if we keep that in mind and we look here at the days, June 14, let's look back at our daily chart. Let's go back here to try to make sure we understand the story. So for June 14, right? That's when they published the article. They said, in the last couple of days, shorting has never been more furious. So when is that? That's these 2 days right here. And I think the reason why we've had a low volume rally and leaving gaps or an island reversal, as Mason pointed out, island reversal just means that we actually still have a gap right here that we've left. So that's the island below, and now we've snapped back. So I believe the reason why we've been able to go up this fast is because we're just doing the opposite of this period right here, where we went down really fast and left multiple gaps, and we dropped by a lot. We actually dropped by roughly 12%. So we're looking for roughly up to 15 from where we are now, and that would just be the start of this low right here. So if we're going to repeat a massive up move, it could just be the opposite of the down move. So it's literally that simple. If we now understand that and we look at, again, where are these guys now going to start losing their money? Where do they go from being green to red? Or are they going to likely start unwinding? Well, once we fill this last gap here. So if we can make it above 400, that could be enough bear fuel or a short squeeze for us to actually claim that 50 MA. So there we go. That's really important for us to understand. More evidence here to explain it is, again, there's been $2 trillion wiped out and US stocks are poised for some relief. Yeah, we got the relief. Is there going to be more? We talked about it. Wall Street classic strategy set for worst quarter than 2008. That's right. One more time. The balanced allocation, trade creators, and age of evolved inflation. So the 60-40 portfolio of bonds and stock are actually having their worst quarter since 2008. So earlier we were talking about, again, are we repeating 2000, 2008? Are we doing 11, 16, or 18? Well, this evidence here tells us that as of right now, the classic strategy is set for its worst quarter than 2008. That's kind of really bad. Why? We also have to check in here on how is the market tracking versus previous declines. And when we were about 100 days in, we were almost perfectly tracking 2008. And this data point here is very recent. It's from June 19th. I'm recording on June 25th. So there's more fundamental evidence that is building up that maybe we are actually having a secular bear market or a rolling bear market. That's what's really important to keep in mind here. So we've looked at the technicals. Now I'm trying to tie the story together with the fundamentals to make sure that if we start to see bullish price action above support or bearish price action below resistance, we understand the reason why. All right, now tying it all together and looking back to Goldman Sachs again one more time. Goldman breaks down what type of bear market this is and when it may bottom. Cool. So now we got Goldman Sachs, or the king of Wall Street, telling us what they think. Let's zoom in a little bit to make sure your eyes can read this. I'm going to read the whole thing actually because it's not all that long and there's actually a lot of insight in here based on what we already presented. Beware the cyclical bear market. London-based analysts at Goldman Sachs warn in an event that studied the difference between cyclical, structural, and event-driven stock declines of 20% or more. Basically meaning, once we've already gone down by 20%, if we understand what drove it, a cyclical decline, a structural decline, or an event-driven decline, now we have the template for where we could go from here. And again, they gave us a recession target of 3150, so we got to take what they say with a grain of salt, but let's keep reading. Goldman said Tuesday that investors are suffering through a cyclical bear market, one marked by high inflation and rising interest rates that are driving down stock valuations, but are cushioned against a structural bear market by strong corporate and household balance sheets and negative real rates. But again, are cushioned against a structural bear market by strong corporate and household balance sheets and negative real rates. So they think that we're not going into a structural, we're doing a cyclical, which means it's going to be shallow. That is the base case right now. If we get evidence that we're going into a structural bear market, that is when we could get that 2000 or 2008 decline. The good news is that the average cyclical bear market lasts 2 years, far shorter than the average 3.5 years for a structural bear market. The average price decline during a cyclical bear market is only about 31 versus 57 during a structural one. Isn't this getting interesting? It is. The bad news is the current bear market is only about 6 months old, which means we got about another 2 years to go. Or, as Goldman says, in terms of performance, we are getting close to this kind of sell-off, but duration is far shorter. And I'll take a moment here to actually jump forward for one section because we've now actually made it to most of our bear market targets. We've now hit 440 all the way down to 360. And now we have to look at, the negative 30 means we only have to go down by another 30 points. We're much closer to hitting our 30% drop than we are to actually reclaiming those all-time highs. So in terms of percent declines, we're almost there. In terms of time, we have about another 1.5 years. So that would imply a 1.5 years of chop. What might change? When might conditions improve? Goldman said the low point in the stock market usually comes about 6 to 9 months before earnings per share bottom, 3 to 6 months before the economy low water mark, and only after inflation has begun to recede. So this is really important because what did I talk about before? I talked about how we have earnings season kicking off on Thursday. And again, earnings season is a season. It happens 4 times a year. It's every quarter. So they're telling us here that markets usually bottom 6 to 9 months before earnings per share bottom. So we have to ask ourselves, are we going to likely be seeing an earnings recession? And then 6 to 9 months means 2 to 3 more earnings reports. So are we starting the first one? And then 6 months from today, or meaning July, we're going to start seeing that regain? Or are we actually only starting the earnings depression now? That's why it's going to be so important that we pay attention to what comes out of the earnings season. I would caveat this as well by saying that the Fed stress test on on Thursday night, told us that these banks are capitalized for a deep recession, or a structural one. Weaker inflation alone won't be enough to push stocks higher, Goldman said. Inflation peaking is not always enough if you do not have other conditions in place. Low valuations, a reasonable expectation that growth will turn, and signs of interest rate policy beginning to ease. For stock markets, the turning point is often around the period when rate expectations start to moderate, the bank said. Since that won't happen until 2023 at the earliest, the rest of 2022 looks like a write-off. Crap. Hopefully you understand this too. I would encourage you to just rewind and replay if you don't understand this, or go to the article. Goldman also warned that the next bull market, whenever it comes, will not resemble the last one. Instead, the next recovery will be marked by inflation rather than deflation, higher cost of capital, a withering of globalization in favor of regionalization, scarcer basic materials, more expensive labor, and commodities, and increased attention to profit margins rather than sale gains. All right. So how do we tie this all together? Well, again, NASDAQ 100 valuations are pretty much where they were going back to 2018. They've pretty much gotten a reset. We can also keep in mind that, again, I'm going to actually go to Mark Minervini here, and I'm going to read what he says too, because he's providing a lot of really good insight in terms of what we just read from Goldman. I'm going to read them in order too. Bear markets lead to bull markets, and this bear won't end any differently. The question is when, and that has to do with inflation, rates, and how much the markets have already discounted. Our work suggests the market has discounted a good amount, notwithstanding a deep recession. Or what? A structural bear market. So again, we read here that as of right now, we're going into a cyclical one, and that's pretty much the same language that Mark Minervini is using here. Again, he's talking about notwithstanding a deep recession or a structural recession. I think it's time to start entering the idea that small cap and mid caps may be the leaders in the next cycle. The mega cap past leaders will bounce from beaten down levels, but for the most part, they are morphing into stalwarts. So what he's talking about is that the leaders of yesterday might not be the leaders of tomorrow. In the near term, bad economic news is good news, and we saw that with the consumer confidence coming in on Friday and actually being 50. The market ripped 3% on Friday. However, if the Fed remains aggressive and inflation starts to come in, the focus will shift from inflation to recession. And if it looks like the Fed went too far, that could prolong the bottoming process. So if the Fed raises rates too much, that could create the recession, right? They could create it. If inflation comes down quickly, the market could rip higher sooner than later. The key to remember is bottoming is a process, making a low, carving out a bottom, and when stocks are moving up in earnest are three separate components of which I'm mainly interested in the latter. So bottoming process, making a low, carving out a bottom, and when the stocks are moving up in earnest are three separate components of which I'm mainly interested in the latter. What he's talking about is let the bottom get formed like we kind of did here, and then I would call this an earnest day up, a gap and go, a 3+% gain. So what does that mean? He's pretty much calling for, if this is the bottom and the bull party has legs, we should see a move up in earnest. Minimum, right? 410. Let's go. All right. So that is a large part of what I wanted to go through. There's actually one more thing I want to go through. I want to have a look at some options as well. And at about 39 minutes, this is actually about the same length as last weekend's video, but I want you to tell me whether or not there is more value in the video so far, because I'm really trying my best to evolve the show over time for what I would likely want to hear as a viewer. So we went through the key economic data. We talked about how the Fed's going to be talking at the ECB. One more thing I want to talk about is going to be, again, the The Supreme Court's decision in terms of, right? You know the word starts with a G, and the other word starts with A. I don't want to say them just not to aggravate the YouTube algo, right? Praise the algo. But here, what I'm personally noticing is that I'm starting to see some more evidence for Ray Dalio's thesis on the changing world order. And this one's really important to me because this happens really slow. But I think that what happened last year in terms of the riots, what's happening over the weekend, this is just telling me that the US is facing some structural issues. And for us to avoid a structural recession, a lot of these issues are going to have to get resolved amicably. And I think that as we're heading into the election, which comes into the later part of 2022, and Goldman Sachs already said as a write off, how we're going to react to these events and whether or not there is uh, a peaceful election, and the outcome is going to be really important. I will leave the link to this video in the description if you want to watch more. And again, it's just really important to understand not just what's happening in the stock market, but what could ultimately happen in terms of other big cycles that we have not seen in our lifetime. And Ray Dalio has done all the work, and I would really encourage you to watch that one. All right, so I'm looking through here. I think I actually got through most of what I wanted. So we went through the psychology chart, talked about the upside, talked about how a lot of money is still trapped. If we can reclaim 428, starts to give us a lot more juice. Getting back above the 50 weekly means that we're probably starting a new bull market. Who are the leaders going to be? We'll look at that after. Talked about hedge fund selling. Let's actually just move forward here. Why bull or bear? Value compression, 454, impenetrable fortress. That 454 seems really important still. Why? That would be above our that's our neckline on the head and shoulders pattern. And then also now that's going to be back above the 50 weekly. DXY and TNX breakouts, recession risk, tech leading to decline. Check, 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 check. Surprises, China. Powell. We haven't seen those tariffs get removed yet, so there's potential for that. For the bulls, we talked about this for a while now. That's falling wedge breakout, and we actually got it. In terms of the bears, right, these pesky bears, the question is, are we going into a cyclical or structural bear market? Even a cyclical bear market should lead to a 30% drop. Have to be very mindful of that as well. Now as we look here to the Fed balance sheet, it actually did not even actually contract. The video is already 40 minutes. I could drag this out by talking about the Fed again. They actually expanded. The balance sheet actually expanded. It's incredible. So anyways, that is pretty much our bear market, and this is pretty much a structural bear market. Now that I'm looking back this in hindsight, this is the screenshot from our original bear market thesis and how we could actually have that structural bear market. All right. So now we're going to look at some charts. Actually, before we look at charts, let's just look at the options chain really fast. And what I want to do this week, people actually ask a lot of questions about the options. So what I want to do instead is actually show you how I actually look at this. This is from my TD broker in Canada. The data is just presented in a way that's visually appealing to me. So here what we're going to look at is just first of all that we got an expiry on Monday, Wednesday, Thursday, Friday, because Thursday is going to be the last day of the quarter. And then the first is going to be Friday. So as we look through to here, I'm going to focus on a couple of things. I'm going to focus here on looking at the 16s, which just means we're looking at 16 strikes or 8 strikes below the current price and 8 strikes above. So what you often see me do is just snap a screenshot, and all I'm doing is looking at this here. I'm snapping a screenshot, and I'm just looking to see the date, number of strikes, and then I'm looking at where does my eye naturally gravitate towards. Well, I'm usually looking here to see what is an open interest. There's nothing above 10,000. I don't care. What about calls? Nothing above 10,000. Don't really care. So again, open interest tells us whether or not people had the balls to hold on overnight. If they don't, I don't really care about it. Why? They don't have the balls to hold on overnight. I don't really care. Where does the activity start here? Well, it starts at about 390 for Monday and goes up to where? About 395, 5-point range, which is already inner support and resistance areas. And again, there's quite a bit here too, right? 100,000 roughly options at about $2. That's a lot. Looking over here on the bear side, starts at about 387, or where we were basing for a large part of the day in one of our key levels as well. Down to roughly 385 with continuation to about 383. So this one here is pretty boring, right? Pretty much tells us that between 387 and 390 would be max pain. All right, there we go. So Monday, not all that interesting. Looks for continuation, kind of what our bull case already said. Now we're going to look forward here to Wednesday, and this one's going to be important. Why? Well, again, is there a continuation from the levels we just noted? 390 up here to about 395. And there's open interest at 395. So that's bullish continuation. On the bear side, we got 387 down to 383 again. So that is pretty much what we already looked at. All right. Now we're going to go to the bonus OPEX, which is going to be on Thursday here. And this is one that's interesting because it's a date-based one, not a Monday, Wednesday, Friday-based one. So as we look here, we can note that, what's the first thing that sticks out? Continuation, sir. That is correct. So we see continuation here between 390 and 395 with what? Open interest and open interest. So that's really notable. We can now actually get a number here at 395 plus the premium of about 250 to get us roughly to 397.50 for break even on these options. Interesting. On the flip side, do we have anything here? Well, we got 390 down to 385. And the reason why I focus on the 16s is because this is the most likely range for us. It's the most likely range. It does not mean that numbers higher or lower can't hit. It just means that's what's most likely. For 1 second here, what I'm going to do instead, though, is I'm going to look beyond the 16s because the move for SPY for this week is 24 points. So if we're only looking 8 points up and 8 points down, we might be only seeing part of the picture. So now we're going to go to all, which means we're going to look at all the strikes. And I'm going to show you the reason why, because I previewed this ahead of time. There's actually a whole bunch of puts here. Yes, sir. And I know that because I've been paying attention here. So it actually looks like it's a 385 up to about, right? So let's actually look here. So let's go from roughly, there's actually volume to 400 as well. So 400 down to about, I would call it 380 here. Again, we're looking at this number here, 100,000, but there's actually open interest that goes down to 370, 365, all the way down to like 360. Those numbers are probably not going to happen, but I want to focus on between 400 and 380 here. So now I'm going to do that same thing where I'm going to snap a screenshot. I'm actually going to focus on 380. So now we're going to snap that screenshot here, and we're going to look and see. All right, so first thing for me is I'm looking at the open interest here at 380. That sticks out to me like a sore thumb. Over on the call side, I noticed that we got 385, 390, and 395 here, actually going all the way up to 400. The open interest tells me that it's actually looking more like a 385 to 395 call spread. And then we have just additional follow through all the way up to 400. So up to 395 and 385 to 395 is where the bulls are most motivated, but they are motivated up to 400. And again, we talked about getting to 405 by Friday. This shows you motivation from the bulls to get us there. On the flip side, when we were looking at let's actually go back to our support and resistance levels because I think trying to explain things well enough. Oops. What's going on here? My mouse is getting all funky. Let me actually check one thing here really fast. I think my memory might be getting all right, there we go. Anyways, so looking here at support and resistance, we know that support 3 and 4 actually come in at 381 and 379. So if we're going to re-lose those 2020 highs, what that pretty much tells me is that those options are going to be going in the money. So they're going to want us below that 380 area. So if now we bring this back over, and hopefully this is going to work. Here we go. So again, looking at 405, 400 to 405. Yeah, well, that's how we get these options paid up, these 400s here. If these 380s get printed up, again, they're still worth about $2, but because this was held as open interest, we can actually assume that they paid about $7 for them. So we have to be quite a bit below 380 for them to get their money back. That's really important. So that's where the support and resistance areas become that much more important. Last thing I want to look at here is going to be, again, we're looking beyond the 16s. Now we're going to put it back to the 16s and jump forward to July because we noted those important dates going through to July. So what I noted last week was what was missing for me was bullish continuation in terms of options flow going all the way through to July. And again, just to remind you, the reason why that's important is because we have some key dates coming out this week, but the bigger, more important dates all come in July. Each one of these is a significant market-moving event. So with options expiry for July coming in on the 15th, that comes in where? After Payroll Friday, after CPI, after the 14th, but before the Fed. That is increasingly important. So on the 16th here, let's just have a quick look and see if there's anything that sticks out to us. Well, over here, what is there? There's only options that have more than 10,000 in open interest at 385, 390, and 395. On the put side, fat at 397, fat at 395, fat at 392, fat at 390, fat at 388, fat at 385, and we got volume here too. So, right, we got volume all the way down to here. So now we're going to look beyond the 16s because it still looks like the bears are significantly more motivated beyond only the quarterly and monthly expiry. So, all right, close that out. Let's go back to all. And now let's actually look at all these chains. So now let's go back in time here. And again, we're not going to look at the like that low, but let's look all the way up here bullish. So, okay, there's a little bit up here to about 420, a little bit at 430. Let's note the numbers, right? About the premium's not even $1 here, so we're going to skip those. Premium here is not even $1. We're going to skip those. Premium here is $1. So up to 410. What is that? That's above our 50-day moving average. Looks like there's also a strategy here with 24,000 volume at 24 and 24,000 at 410. That's notable. However, on the put side, what do we got? We got fat stacks here. We got fat stack at 410, fat stack at 400, a fat stack at 395, fat stack at 390, fat stack at 385, fat is stacked so far at 380, fat stack at 375, fat stack at 370, fat stack at 365. We got a fat stack at 370, 100,000. Got a fat stack at 355. Got a huge stack at 355. This also looks like a spread here. 360 down to 350. And the numbers just keep getting bigger as we go lower. Another 45,000 at 340, 91,000. Right? This is depressing. Why? Because they're just buying these up. They're gobbling them up. So for me, this tells me that there is very little follow through for the bulls beyond this week. It looks like the bears are taking advantage to just go in and gobble up all puts for July 15th. All right. So again, a very long video this weekend anyway. I think that I can probably trim these down a little bit going forward, but now we're going to look at a couple of charts here just to wrap it all up. But I think I did a great job reviewing the charts this weekend. So let me know in the comments what you think. If you're still watching, I really appreciate it. Again, we put out videos every day but Sunday. Encourage you to subscribe to the channel, smash a thumbs up, and leave us a comment. QQQ. So awfully close to that 200 weekly, and looking like it wants to potentially go back up. I'll be watching 303 as a key area. DXY actually putting in a red week, down by 0.5%. There is a bullish pattern here as well. Again, continuation from the W. We got a golden cross. We got a win. It's a back test. A weekly close above 105 is where I start to get a little bit apprehensive in terms of the DXY. With the ECB conference this week, Wednesday will be the catalyst. The VIX actually taking back down double digits. That's nice. 2-year Treasury note has a down week as well, still closing above 3. And we also see a lot of flattening, which means that they're really close to each other. 307 for the 2-year, 313 for the 10-year. We failed to close above key resistance as well. Did poke above it, but did not close above it. That's important. Jumping forward here, we're going to look at the DAX. DAX is what? Oh, crap. It's below the 200 weekly. Yes, it is. Yes, it is. We're expecting a recession much sooner in Germany than we are in America. Crude oil, basically unchanged on the week. This is, again, it's going to be important for us to track. Not the most important thing, though. We have oil inventories coming up this week, I believe, too. Gold. Well, if you think about this, again, gold is what? Well, it went all the way down to its 200, reclaimed the 50, bounced off the 50, lost the 50, reclaimed the 50. This looks bullish to me. BTC. Lost the 50, lost the 200. That's all we need to know. It's currently battling for 2017 highs. Yikes, it's 2017. Ethereum battling for that 50 weekly, and it is currently battling for 2018 highs and 2018 neckline here. We also note the volume, right? So where did my mouse go? Oh, I probably have another display on here because that's stupid Apple computer. Lots of volumes. Is that capitulation volume? I don't know. I'm paying close attention. Apple, woof. Here we go. Right back at the falling wedge here. So, right, 7.7% on the week. That is huge. So that looks nice. Microsoft approaching that key relative low at 270. It would actually break the downtrend next week at about 273. So again, if we get a repeat of this week, next week, it's going to break bullish. Google needs above roughly 2,500. Looks like it can start to go though. Key relative low or high here is going to be about 2,450. Amazon bouncing off the green line or our 2018 highs. We are still below our 200 weekly moving average as well though. Have to reclaim that at about 127 to reclaim bullishness. Tesla reclaim its relative low at about it's actually a lot closer to its 50 than its 200. So I'm looking at the 50 MA here. So the 50 MA is actually a lot closer, and it's about to stop going down. So that's actually pretty bullish. Meta actually closed green on the week. Oh my goodness. Gonna snap back. It's way below the 200 MA right now at about 230. Has to rally up by 60 points to get there. Nvidia, nice push off the green line, and it's down more than 50% peak to trough. Let's see if there's some juice in the tank. Moving forward to these ETFs, DIA closed the gap, bounced off the 200, bounced off the 2020 high. So bounced off the 2020 high in the 200 weekly, refilling the gap. Let's see if there's some juice to re-enter the yellow pocket here at about 322. XLK also bouncing off the green line or our 2020 high. And again, looking for a move up to potentially 141. The Russell, again, back above its 2020 highs. It is still below that 200 weekly, though, at where? 176. Watching that area really close. ARC, right on a key relative low here at about 46. Going to have some juice in the tank. Going to get to the next low at about 52. Let's watch it closely. Why? This is a great risk sentiment because it is way below the 200 weekly at about 74.5. If it can get above 52, I could see it shooting up potentially to 75. That's about a doubling from here. NYA, reclaiming the funnel. So reclaiming this blue line here. And it's actually touched the 200 weekly. That's interesting. RSP, kind of a no man's land. Still have a technical gap on the chart. It's testing the key relative low here at about 138, though. XLF, volume is elevated, but not crazy. Bounced off the 2018 highs, exiting the the demand zone. If it can fill the gap in advance, looking for up to about 35. Might have to happen into earnings, though, if it doesn't happen this next week. XLV, that 200 weekly is way, way, way below. What a powerful candle. Let's go 777s. Is XLV going to be lucky with the 777? It looks like it wants to. This is a nice move. It's actually pretty close to reclaiming that 50 MA as well at about 1,325. Energy finally coming down, and energy has been almost inversely correlated to the market going up. So is this decline on XLE of roughly, right? We've declined by roughly 25% now. If we get another cut on XLE, this could be signaling a bottom in the broader market. Utilities all the way back up to that 50 weekly here. Really interesting. Watching that close at 69.2, sorry. Emerging markets, trying to form a base, testing the key relative low here at about 41. And then FXI starting to form a W here, right? Kind of, or a cup and handle. Does it have juice? Going to reclaim the 50 weekly. Let's watch it closely. All right. So with that said, I thank you very, very, very much for watching. And I wish you guys all the best of luck in this next trading week. If you want to see my original bear market thesis for 2022, I will leave a link to that. So if you're more interested in watching more content, it'll be there. But otherwise, I really appreciate you watching all the way through to the end. We will be back on Monday for our regular uploads and back on Friday for our stream. Thank you for watching. Wish you all the best of luck this week.